As one of the largest constituents of the S&P, Facebook, or now more uncommonly known as Meta Platforms, makes up one of the FANG stocks, the mega-cap tech stocks that carry a significant weighting of the index. Meta is the social media behemoth that owns household names such as Instagram, WhatsApp, Facebook, and more, and for many reasons could be the best pick of 2022 out of all of the FANG stocks. Facebook rebranded to Meta Platforms to separate its image from the social media darling that is Facebook, that has come under fire as of late, and to focus its sights on the future technologies and platforms within the Metaverse. In this video, we will uncover why Meta Platforms could be the value growth stock opportunity of 2022, what the transition to the Metaverse looks like for Meta, as well as other companies, in any catalysts that lie ahead for this stock. We will also look at the risks for Meta going forward, what analysts think of the company, and at the end of the video, we will give the stock a rating out of 10. If you like this type of content, consider subscribing to WiseWealth for more personal finance and investing videos. So without further ado, let's get into it. As of this video, the stock currently trades at $332 per share. As you can see from the financials, Meta is a cash cow that consistently pumps out enormous revenues with high margins. Year-on-year growth is solid and continues to grow at double-digit levels. With solid free cash flows, Meta is a quality technology stock and, like most FANGs, has proven to be a flight to safety, where investors flock to for shelter in anticipation of wider market volatility. This defensive nature means these mega-cap tech stocks are suitable even for the defensive investor, heavily inspired by Benjamin Graham's The Intelligent Investor. With valuations coming back down to earth in a high inflationary environment, where the market is pricing in interest rate raises, the market has become skittish when investing in tech stocks generally. However, I believe that it is unfair to paint all tech stocks with a broad brush. Many speculative growth story tech stocks, with no present-day profits, are highly sensitive to interest rate raises, as the bulk of their revenues are forecasted far out into the future, which erodes the present value of the stock on a DCF valuation basis. Meta is less sensitive to these increases for its strong present-day financials and free cash flow. This is one of the best tech stocks if investors still want exposure to the sector among a rising rate environment, along with others such as Google and Apple. The stock is currently down over 10% from its all-time high of $384 and could prove to be a good entry point for investors looking to start a position in Meta, or for those looking to add to an existing position. With the current PE ratio of 24, the lowest of any FANG stock by quite a margin, Meta trades at a valuation in line with the S&P. For the consistent double-digit growth that Meta delivers, this is an extremely low valuation, given the current market dynamics, especially when considering the average 12-month trailing PE of the Nasdaq is 37. So, with an attractive valuation, already without factoring in any additional revenue streams, what does the transition to the Metaverse look like for Meta? The first thing we need to do is discuss what exactly is the Metaverse, and why is it such an exciting growth opportunity? The Metaverse is a virtual world in which people can interact with others. For a social media company, this is the primary function that Meta will look to capitalize on. And this is not a concept without successful precedent. Companies such as Roblox and Riot Gaming have profited massively off users interacting with one another virtually through avatars when it comes to gaming. And the idea of the Metaverse is more widely adopted than people think. So, what separates Meta from others? The primary advantage that Meta has is time and resources at hand to deploy. Many may not know that Facebook owns Oculus, the leading company specializing in virtual reality hardware. This has been in the works since 2014, when Facebook originally acquired Oculus for approximately $2 billion. Mobile is the platform of today, and now we're getting ready for the platforms of tomorrow, said Zuckerberg back in March of 2014. As a leader in VR hardware and one of the largest technology companies globally in software development, Meta leads the way in pioneering an immersive transition into the metaverse. The winners of the transition will be the likes of Meta and Nvidia, who have been setting up foundations for a decade, rather than those who are jumping on the bandwagon to sound impressive on earnings calls to investors and analysts. So how exactly can Meta monetize the metaverse? The first way is through platform services, providing an environment in which companies or users can enter the metaverse. Facebook can charge for access through licensing fees, much like a subscription to the gym or a members club. Alternatively, it could be free for the user to access but gain revenue through advertising spaces, similarly to Meta's current model on Facebook and Instagram. Another revenue stream is the collection of royalties on transactions in the metaverse by third parties. But what exactly can you sell in the metaverse? The answer there lies in NFTs, or non-fungible tokens. These are unique digital datasets that have a single source of ownership stored on a blockchain. An example of this is a clothing brand selling digital assets in the metaverse like they would do in a real-life store. The user owns that digital asset and can either use it in the metaverse or sell it on to another user, creating an untapped virtual marketplace. NFTs are a huge revenue segment that many businesses have not tapped into. An example of a company that has moved into this space is Gucci, who made digital trainers aimed at gamers with a price tag of $12 per pair. Although they're far cheaper from the real product, it is unlocking a high-margin revenue stream that simply did not exist before. And with Meta as the platform provider, they could be entitled to a royalty for any transaction made within the metaverse, should they decide to monetize that way. Some analysts have even predicted that this marketplace could reach $56 billion by 2030. As more aspects of people's lives are moving online, the demand for digital fashion and goods will increase significantly in the coming years. So, what are some of the risks that lie ahead for Meta? The first is execution risk. New technologies and platforms are rife with skeptics, and the metaverse is no different. Many who are not well informed on the benefits it may bring and the revenue streams it could generate are quick to dismiss it as a fad. There is also the argument that other segments of the market may benefit more from the metaverse, such as Nvidia, who are developing their own Omniverse platform, which is more widely used for commercial purposes. Not only this, but semiconductor manufacturers and chip makers could benefit significantly from the fact that they will be the suppliers powering the move to the metaverse. Another risk is the overhang of negative sentiment. The share price has been hit hard after internal investigations at Facebook concluded that Instagram is detrimental for young children and their mental health. While this is not good news for the company, and there is definitely reason for investors to worry, I do not think that this overhang will remain long into the future. The market consistently overprices or underprices stocks based on sentiment, but the value of a business does not change much day to day. This mispricing can only persist in the short term. Over the long term, market prices will correlate with underlying earnings generation, which is much closer to the value of the business. The market can only be negative about a company for a short period of time if that company continues to grind out excellent earnings growth. One of the reasons I am highly confident that Meta will do this is the announcement of a monumental $50 billion share buyback program, which will significantly reduce the number of outstanding shares and boost their earnings per share. Another risk is the increase in cost of retaining talent. It was recently reported that Meta is having to pay employees significantly higher wages to retain their services amid the recent PR problems. Employees have been leaving the company to work for other Silicon Valley giants such as Microsoft and Google to avoid having Meta on their CV for too long. This, however, is not unique to Meta, as Apple have also been struggling to retain talent, with reports of stock bonuses of up to $180,000 given to engineers to get them to stay. There is clearly a war for talent in Silicon Valley, which poses the question, is this spurred by inflation, and could it lead to a wage spiral? The final risk is regulatory pressures. these remain an overhang for Meta, as well as other mega-cap tech stocks. Data protection laws make advertising giants a target, and the size of some of these companies has put them in the spotlight. The allegations by whistleblowers have tarnished Meta's reputation, and it may take time for some investors to regain confidence in the company. Only time will tell. Moving on to analyst recommendations. What does Wall Street think of the stock? Out of the 40 analysts that covered Meta in the last 12 months, there are 2 strong buy recommendations, 32 buys, and 6 holds on the stock. With an average price target of $399.90 per share, there is an implied upside of 21% on the stock. I think this is a very conservative price target given Meta's current valuation and many of the Metaverse revenue streams not accounted for. In summary, Meta is a quality stock with the power to consistently generate tremendous earnings growth. The negative sentiment remains an overhang on the company for now, but with exciting new technologies in their early stages and fresh revenue streams, I believe the future is bright for Meta. As the cheapest FANG stock trading at a valuation in line with the broader index, I think Meta is the value growth stock opportunity of 2022. For this reason, I would give the stock an 8 out of 10. If you got value out of this video, make sure to give it a like down below and consider subscribing to Wise Wealth for more personal finance and investing content. What are your thoughts on Meta and its rebrand? Did I miss out on any potential revenue streams for the future? Let me know your thoughts in the comments below. Thanks for watching, and until next time, see ya.